Trading without a plan is like playing a poker blindfolded. You might get lucky once or twice, but you lose in the long run. That's why today I'm showing you how to create your first trading plan step by step, so you can start trading like a pro and stop relying on luck. And trust me, by the end of this video you will not only have a clear plan in place, but also learn the top 1 mistake what wrecks most beginners' plans and how to avoid it. So grab a notebook and let's get started.
Don't forget to subscribe my Telegram channel where I write my thoughts on the market, useful information about trading and post my trades. Have fun!
Trading plan is your GPS for navigation the market. It's a document what defines exactly how you approach every trade, from deciding when to enter, when to exit and how much risk to take. Think of it as a business plan for your trading career. The goal of a trading plan is to keep you disciplined and focused on a repeatable process, even when emotions like fear and greed try to take over. Now about key benefits of a trading plan. Structure prevents emotional decisions making by giving you clear rules. Consistency, focus on long-term success instead of short-term wins. Accountability allows you to track and refine your performance. Without a plan, it's easy to fall into traps like overtrading or revenge trading, but with one, you'll trade smarter and more consistently. Coming up next, we are diving into the first step of creating your plan: setting crystal clear trading goals. This is where the magic begins, so don't click away. It's time to tackle step 1: setting clear actionable trading goals. Because let's face it, without a destination, you will just wander aimlessly in the markets. First, set a clear profit target. For example, instead of saying I want to make money, try this: I aim to achieve a 5% return on my account each month. Specific goals like this give you a clear target to work toward. But remember, keep it realistic. Setting a goal to double your account every week is a recipe for burnout and bad trade. Next up, define how much you're willing to risk on each trade. A common rule of thumb is no more than 1 or 2% of your account balance per trade. This ensures that even if you hit a losing streak, your account won't blow up. Here's the golden rule: small, consistent risks are key to long-term survival. If you are risking too much, one bad trade could wipe you out. Finally, focus on improving your skills. Remember, trading isn't just about making money, it's about constantly learning. Set goals like reading 1 trading book per month, practicing in a demo account, or reviewing your trades every week. This is the part most beginners skip, but trust me, the more you invest in learning, the faster you grow as a trader. Now that you know how to set your trading goals, it's time to move on the core of your plan: identifying your trading style and strategy. This next step will define how you approach every trade, so don't miss it. Your trading style determines how often you will trade and how long you hold positions. Here's a quick breakdown of the most common styles to help you decide. If you love fast-paced action and have no time to monitor charts for hours, scalping might be for you. Scalpers aim to make small profits on very short-term trades, often lasting just seconds or minutes. Day traders hold positions for hours but never overnight. It's great if you want a full-time trading career without the stress of holding trades while you sleep. Swing trading is perfect for those who can sit at their screens all day. Trades last from a few days to a few weeks, making it ideal for people with overcommitments. Finally, we have position trading. This is for traders who want to hold trades for weeks, months, or even years. It's similar to investing but with a focus on technical and macroeconomic analysis. Each style has the pros and cons, and there is no one size fits all. That's the key is to chase a style that matches your personality and schedule. Once you picked your trading style, the next step is choosing the strategy. A good strategy answers 3 questions: where will you enter, when will you exit, and how much will you risk. Let's say you choose a breakout trading. Your entry might be when the price breaks a key level of resistance with strong volume. Your stop loss goes just below the breakout point, and your target could be the next major resistance. Or maybe you prefer mean revision. No matter which strategy you choose, always backtest it on historical data and demonstrate it first. This helps you build confidence and refine your approach without risking real money. Now that you've chosen your trading style and strategy, you're on the next step closer to being a disciplined trader. Up next, we'll dive into the heart of your trading plan: risk management. Trust me, this part is what separates successful trades for everyone else. If there's one thing what will make or break your trading career, it's risk management. This is the backbone of your trading plan, the safety net that protects you from blowing your account while letting you stay in the game long enough to create and improve, to learn and improve. Let's start with risk per trade. This is the amount of your trading account you are willing to lose on a single trade. The golden rule: never risk more than 1 or 2% account on every trade. For example, if you have a 10,000 account, risking 2% means your maximum loss on a single trade is $200. This ensures that even if you are losing streets, your account stays intact. Once you decided your risk per trade, the next step is calculating position size. This tells you how many shares, lots or contracts to trade based on your stop loss distance. Let's say your stop loss is 20 pips and your risking per trade is $200. Divide your risk by the stop loss distance to find your position size. In this case it's 10 lots. This keeps your losses controlled no matter how wide or tight your stop loss is. But if you want to don't waste a lot of time on calculating your risk management strategy, you always can use the TradingView risk management instrument and it will help you to calculate it, and in the setting of this instrument you can write your position size and your percent of risk, and it will show you how much of crypto or shares you need to buy. Finally, set rules to protect your account from major losses. This includes daily and weekly loss limits. For instance, if you hit your daily loss limit, say $500, stop trading immediately. Walk away, review your trades, and come back with a clear head. The market will still be there tomorrow. Here's another game changer. Always aim for a positive risk to reward ratio. If you're risking by $1, make sure your potential reward at least 2 or more. This way, even if you win only half your trades, you're still profitable. The key reminder: discipline is everything, but here's the catch. Risk management only works if you follow it religiously. No exceptions. If you let emotions take over and ignore your rules, you are setting yourself up for failure. Think of risk management as your seatbelt. You wouldn't drive without it, right? The same goes for trading. Always protect yourself first. Up next, we will bring it all together and show you how to create a simple, actionable daily checklist to keep you disciplined. Don't miss it. It's the glue what holds your trading plan together. Now that you've got risk management locked in, it's time to tackle one of the most crucial parts of your trading plan: your entry and exit strategy. This is where you decide when to get in, when to get out, and how to manage trades in between. Your entry rules determine what conditions must be met before you take a trade. This removes guesswork and ensures you only take trades that align with your strategy. For example, your entry criteria might include a bullish engulfing candle near the demand zone, a moving average crossover on the 50-minute chart, or confirmation for a momentum indicator like deviation on the RSI. Having a clear entry rules also keeps you disciplined. You avoid impulsive trades and only enter when the odds are in your favor. Next, your exit rules. This is about knowing when to close your trade, whether it's a profit or a loss. Your stop loss should protect you from large losses, while you take profit ensures you lock in gains. For instance, if your risk to reward ratio is 1-3, you'll close your trade once the price hits triple your risk. But what about trades that go halfway to your target and then reverse? For this, you can use trailing stops to secure partial profits while letting the trade run. Trade management is just as important as entry and exit rules. This includes adjusting your stop loss as the trade moves in your favor or in the market condition change. For example, once your trade is up 50% of the way to your target, you could move your stop loss to break even. This way you eliminate the risk while giving the trade room to breathe. A common mistake is overcomplicating your entry and exit strategy. Keep it simple. Focus on a few high profitable setups and master loss before adding more. Remember, the simpler your strategy, the easier it is to follow and the more consistent your results will be. So thank you guys for watching this video. Drop your likes, write comments about your trading plans or questions about it. Follow my Telegram channel, the link by the description where all materials are collected. See you in the next video.